love real estate in the heart of Tennessee. Wouldn't it be great to have all the insider information about it, all wrapped up in one podcast, all from our cozy little studio? Welcome to The Counter Offer, brought to you by the one and only By Tennessee Dirt Studios, nestled right here in beautiful Tullahoma, Tennessee. We're diving deep into the nitty-gritty of Tennessee's housing market. We'll be debunking myths, sharing expert tips, and dishing out advice to both seasoned homeowners and first-time buyers alike. From the do's and don'ts of touring homes to negotiating that perfect offer, we've got you covered. The Counter Offer, where every offer is just the beginning. Let's do this.
So you never gave me an answer. Daytona white face or the meteorite. Yeah, I like the black subdials on the meteorite.
Yeah.
Plus the other one doesn't, it comes with a regular quick release clasp on the band if I was to go to a rubber band, black rubber band. But if I go to I have a butterfly black rubber band that I think I like better. I don't know. I'm gonna have to send you some links. It's yeah. Talking about building wealth. Today we're going to talk about how to get into real estate investing. So we have always talked about, hey, how do I become a first-time home buyer? Maybe you don't want to buy a house. Maybe you want to buy investment property. I think it's funny that how many people I know that don't own a home but invest in the stock market or invest in crypto, but they don't own a house. So granted, some of them can have high returns, but I don't know. It's all about diversification of your portfolio, I think. So yeah, as we're running and gunning here, Brian's approving loans and working through deals and nonstop as we are shooting podcast episodes today. So, Brian, one thing that you've talked about is, what's the difference between traditional, conventional type of financing that we would get to buy our first home versus that we're going to live in versus buying an investment property. Can I get an FHA or a VA loan on an investment property?
Yeah, so great question. So normally VA, those are, it has to be required. Same gravity. You can't buy a duplex or with an equity loan. Launch provider, so you have to live in one of the units, obviously. So those are creative ways. And outside of that, traditional would be a conventional loan, whether you 20% down or 5% down. And that's conforming.
No, when we talk conforming is just kind of a set parameters that mostly every bank uses to qualify somebody for a loan. So it would go off of debt to income, their just overall income, ability to repay, all that type of stuff. Stability and ability, as we would say. You've kind of have you talked in a training that we did with our agents recently about the 4 C's? And then there's 4 different categories that kind of make up a bank's decision. What are some of those C's as our 4 quadrants?
Yeah, you just touched on ability.
Okay.
So capacity, which is the ability to repay cash, getting credit, your willingness to repay it. Obviously, the property, the appraisal is needed. So that's your forming. That's normally what a bank looks at when they approve someone in different forms. But all 4 of those make the bank feel good or not.
Yeah. Because essentially the bank's lending other investors money. They're not necessarily investing themselves. So the other loan programs that, do I have to, let's say I worked at the GM plant in Spring Hill and I make X number of dollars an hour. I work X number of hours a week and I make this much money. I don't have enough money necessarily to afford another mortgage for an investment property. How are the programs in place that allow those four C's to shift weight from one another?
Yeah. So DSCR,
Okay.
which is you use that property that you get out of use and use that to qualify you. So a DSCR score 1, most lenders will know what that means. So they would like to see that. So that means the property has $3,000 in income, and the monthly payment that we draw up for this DSCR level is $3,000 a month. Then that's a 1 mortgage. So we have a DSCR score of 1, and you qualify that person off of that, and not necessarily that in W-2.
So, but the heavy hit on that, not as just as the property going to cash flow, is do they have the stability? So do they have a track record of repaying their debts? Right. And so we're moving that from income to can the income be put onto the entity in which you're purchasing. So that's a DSCR loan that you can qualify without having to qualify off your income. They're not going to ask for tax returns or bank statements or anything like that. Now, you can do a bank statement only loan, essentially, because Aaron and I've done that. We've been self-employed the majority of our life. And bank statement loans work well for us because, as you've said in the past, it's, when you file your taxes, you write stuff off, right? So how does a bank statement loan work, and what's the average type of person that's probably going to use a bank statement loan?
Yeah, so people probably not going to go that route. It's fairly straightforward. There's escort, but if you want a business and you have flexibility to control that and control your expenses and do write-off things, then this would be a good option, because you can make 100,000 gross going out tax return. You make 10,000 because of all of it and everything. So that's where that person makes the component could be a really good option, because really somebody looking at 12 months worth of statements, and we're just looking at money coming in, money going out, and we average that, come up with your qualified income. And depending on your business type, let's say your income is $300,000 a year. Depending on the business, they may only allow us to, we may have to use a 50% expense ratio, which would mean that we can count $150,000 as income out of the $300,000 cases. But it depends on your business.
And so they're offsetting operating costs and cost of goods and all those different types of things by doing that, correct? It's got to be a legitimate business too, right? So I can't be a drug dealer, and unless I'm a pharmacist, however you want to title me, they want to see where the money comes from. You can have an Etsy store, you can sell sourdough bread at the farmer's market. They just want to see some type of where's the money coming from. So big deposits and things like that. You're probably not making substantial amount of money, flipping couches on Craigslist, even though I know that's a huge thing. That's another podcast. So they're going to need some type of track record. We've dealt with clients in the past that have sold a car, and we need a notarized title or a bill of sale saying the fact that they did in fact sell this car. Because let's say I deposited $8,000 in my bank account, they go, well, where'd the money come from? So they just want to make sure that it's legitimate business, because banks aren't in the business of getting into illegal business, right? So short-term rentals versus long-term rentals, things like that. So when we buy a piece of property, we buy a house, and we're going to use it as short-term or long-term rental, how does the bank look at that? Are they looking at that as an asset or a liability? How do I qualify for the next one if I've already bought my first one? So I have my primary residence where I live, and then let's say I have an Airbnb in Knoxville, and I have a long-term rental in Murfreesboro.
Well, a lot of that, you're going to look, if we're looking at tax returns, you're going to look at Schedule E, which just shows profit and loss for the rental. So it simply can come down to that. So I think if you are trying to protect your buying power, just from a most conservative, conforming standpoint, maybe we don't quite have to look at tax returns, but just understanding your tax returns, understanding that if that property is showing $12,000 in revenue annually, and you show $12,000 in interest at moving with taxes, then you're kind of net neutral, right there. So you just want to make sure you just want to make sure you understand how that impacts your situation. And again, I find someone to have someone like us in your corner, your CPA in your corner, is really understanding how to stay ahead of things. It's just nuance there. But you could be moving out of the house and buying a new primary and never rented that house before. You can give me a lease agreement the first month rent check, and I can immediately announce original income for that property.
Right.
So there's definitely ways to get forgiven and I would offset and ideally cover the debt load that property has on it.
Right.
Some people would qualify for mortgages, but some may need to offset that liability to make sure that
so let's say I don't have any investment properties yet per se, but I have a primary residence. I bought I'm a young bachelor as an example, and I bought a 3 or 4 bedroom house. I go to MTSU, and I rent the other rooms to friends. How do I use that as qualifying income to offset my mortgage so that I can buy another one? Don't accept payments in cash.
Right. Yeah, if you're, in case you are just,
can you use Venmos and stuff like that type stuff as long as they put in the notes of what it is?
And stuff. That people use.
Because it's a very common way. I know a lot of people that that do rent that they Venmo or L or whatever payments that way. So it's just more convenient. So I guess my thought process around that question is, how traditional is banking nowadays, and how are you guys how are underwriters adapting to new ways of doing business? So have they gotten to the point yet where I can use crypto income as a qualifying income?
Well, yes. Gray area there. You're a day trader. It would be just like day trading. There's a 2-year track of you trading or some type of track record. Probably count that as income. You could also liquidate crypto, get it into your bank account, and do that in certain ways. And that's also, you're not necessarily going to necessarily buy the house with Bitcoin. Even though some people have, but using traditional conforming options like we're talking about, it's just like selling video or Apple. You would just realize that you're selling and get back into your bank account. It would be similar to liquidating a account.
Yeah.
You just have that.
But the reason I asked it is I saw a recent, TikTok or something like that, or it might have been part of a podcast. The Ryan Serhant's team in New York that they had it could have been just scripted, but one of their agents wanted to be paid their commission in crypto. So they were like, well, we'll pay them in U.S. currency for 50%, and then we'll pay them 50% in crypto, which kind of was just a different way. Those two things are melding into real estate. So, so getting started to get out there and do this type of stuff, of course, you're going to need some type of ability to do things. So let's say you've got a credit, but you don't make a ton of money. So can I be a middle income manager at Target making $40,000 a year, but I've got a stellar credit score, and I go out here and I want to do a DSCR loan on a property?
I mean, you have to do it. Some DSCR, sometimes they want to see results. So not all the time.
Meaning you have a track record of renting to people?
Of renting to people. Generally have that property a past sample you can show some experience. So sometimes if you're a first time home buyer and you buy, you never have a rental, that could be maybe a little bit. But it's still,
yeah. So building wealth, the biggest thing is not all rental properties, not all investment properties are necessarily an immediate return financial investment. Some of them, as you were saying, like a 1-to-1 ratio for a DSCR loan is, my mortgage payment on this income property is $2,500 a month, and it brings in $2,500 a month, and there's no positive cash flow. There are other ways to benefit from it. So let's say it's a short-term rental. You can benefit from it from accessibility of use. So let's say you own a short-term rental and you and your family spend $2,000 a year going on vacation. Well, you can go stay there now, and you can go to the beach, or you can go to Knoxville, or you can go to Chattanooga, or wherever you want to go, wherever you get a short-term rental at. You can, go to Disney World and have a short-term rental there. And the off season, when you're not using it, you can rent it out. So you can get that return on it that way as well. And then every payment you're making towards it is going towards, some of it's going towards the principal, and you're paying it down, and you're not paying it out of pocket. It's paying itself. So even though it's paying some interest towards it, it's not necessarily, that interest isn't coming out of your pocket. So it's a win-win. So you may finance a home in the, let's say you finance a $500,000 house, and your mortgage payment is $3,500 a month, and you're using an income property and it's breaking even. Your amortization schedule on it may be only, $300 a month for the first few years on average towards your principal. But you're not paying that interest, and that $300 a month is essentially, without inflation, is essentially free money to you. Just to, think of other ways about how you're going to get the return on this investment. We've talked about in some previous videos too about building wealth and leaving a legacy. Having doors, as we would talk about in real estate. How many doors do you have? It's kind of the thing to talk about. Let's say I was passed away today, and I had investment properties out here, but I'm not able to put money into a savings account or a 401k or invest in the stock market or anything like that. I go out here, I'm leveraging my good credit so that I can get some income properties working for myself. And then I pass away, and my family doesn't have a savings. They don't have a retirement. They don't have anything. Cassandra could start selling off properties. She could start leveraging some of those and cashing out some of those benefits, and take advantage of that if need be. So it's just another way for you to work on generational wealth. And I'm sure we'll do a video here in the near future about generational wealth, and so that your kids, we always want things better for our kids, right? So yeah, sometimes in the afterlife you may have to look down and enjoy that gratification. My biggest fear in life is not knowing how stable my family is going to be without my presence, because it's, very traditional. Sometimes it's, in traditional households, the husband has always been the breadwinner. Husband disappears, guess what? There's no income. That's not necessarily true in our case because um, we're both agents, and we're both agents for a reason, so that stability continues on. So, um, what's your biggest piece of advice if somebody wanted to get into real estate, either as a primary residence or as an investment property? They just go, hey, I'm making some money, I'd like to get into this. Everybody sees those get rich quick schemes. I'm going to 10x this and I'm going to do this and that. And they go to these seminars and they pay this big money and they go, hey, it's $10,000, but guess what? It's $99 this weekend if you come to the seminar. If it was that easy, and they can put 10,000 people in a room, everybody would be doing it. Should they spend their money on that, or what's the best way to do it? Pick up the phone and call a lender, talk to somebody that actually can make it happen for them.
Yeah, man. Answer. I do. But I don't know, everyone's going, yeah, I believe in real estate. I believe it's the right time for you. If you're going to be in an area long enough and you don't have a primary residence, you might as well, you could buy one and out of it. Keep it. That's the easiest way to get around it. So a little bit of a small process. So yeah, there's one right there. Everyone's different. I think having conversations with people like this, we can help maybe add some clarity. Because that's really all I can do. We're having a conversation just to provide all of the details, to provide content and clarity for that, so that you guys understand what we need to do.
Yeah.
At least just have a conversation.
Pick up the phone and have a conversation. Talk to Bryan. Get on his calendar. His Calendly link for his schedule and everything is on our website. All his contact information, or you can shoot him a quick note at the bottom of the page there. So talking to the lender, making sure that, hey, this is how we want to structure a loan based upon my lifestyle. Hey, I think we're going to use a bank statement loan, or we're going to use a DSCR loan, stuff like that. And then make sure that lender's communicating with your agent. So if you came to us and said, hey, I spoke with Bryan, I'm interested in getting into real estate investing. This is what I'd like to do if we can find the right property. It's not a traditional home search. We're not going to hop on Zillow or the MLS or anything like that and go out here and run out and go, let's start touring homes. We're going to look for off-market type listings for you. Hey, I've got somebody coming to market with this. Hey, I have somebody that would be interested in selling this, maybe a pocket listing type deal, that we can put you in front of. Yeah, we can make this happen. And that if you have a good agent, we're going to be able to pencil out the numbers for you to go, yeah, this cash flows. Here's the reports. This is what it should rent for, all these different types of things. So it's all about relationships when it gets into investing and things like that. These guys that go out and buy them constantly, they're not out necessarily doing all the legwork themselves. They've got relationships so that they know, hey, I can sell this. I bet Johnny wants it, and they can go take it to Johnny, and Johnny goes, yeah, that's exactly what I'm looking for, and they take it. So real estate's a little different in that mindset, but it's not super hard to get into. So, and you can start the other way around. You don't have to buy your primary residence. If you're not a homeowner, you don't have to make it your primary residence, even though that's a good investment opportunity. You can start using it to level up. Think of it like this. If I had to go buy a car, I'm going to buy a car to drive Uber. So, because now I can have an income off of that car. So, so just leverage your money, leverage other people's money. That's the key.
And live in it. Roommates.
Mm-hmm. Yep.
Rent. I mean, there's just a lot of ways where you have to sacrifice short term, but back to that late, right? You're insured that, you're.
Yeah. Cassandra went to Chico State, and it's, I saw a lot of people that was going to college there it just made more sense. It was cheaper for 4 or 5 students to get together and rent a house, and one of them bought it, or one of their parents bought it, however that plays out. And whoever the primary is on it that bought it is living there for free, going to school, and all of his roommates or buddies or girlfriends or whatever are paying the bill for him. So, yeah. So if you guys want to get into real estate investing, this is just a little snippet. We can dive into anything else. And there's a bunch of other options available for you guys too. So just pick up the phone and run from there. If you want a deeper dive, we'll get into investing in land and how that works and developing. And you want to talk about a heavy lift. Or you can just go the easy route and find a house and rent it to somebody. So hope you guys have a good week. Thanks, Bryan, for being here.